Why crashes never start. Where you're looking, most people believe financial crashes are obvious before they happen. They imagine flashing warnings, collapsing stock charts, and nonstop breaking news. But history tells a very different story. Real financial crises almost never begin where the crowd is looking. They start quietly, off to the side, in places that seem boring, technical, or unimportant, until suddenly they aren't. By the time the average investor notices something is wrong, the crash is already in motion. That's not an accident, it's a pattern. Before we go any further, if you value calm, system-level analysis instead of panic and noise, take a moment to like this video and subscribe. It helps channels like the Silver Collapse Report continue breaking down the financial system beneath the headlines. Now, let's talk about attention. Financial markets are driven as much by focus as by fundamentals. When everyone is watching the same indicator, stock prices, interest rates, inflation numbers, risk tends to build elsewhere. Pressure accumulates in areas no one finds exciting enough to monitor closely. In 2008, most investors were watching stock markets. The real crisis began in the credit market, specifically in mortgage-backed securities, complex instruments most people never understood and very few watched closely. By the time banks began collapsing, the damage had already spread everywhere. In the Asian financial crisis, people focused on booming growth and strong currencies. The fracture started in foreign-denominated debt. In the dot-com crash, attention was on technology stocks, soaring to absurd valuations. The real break happened when liquidity dried up and capital stopped flowing. The lesson is clear. Crashes don't start with prices falling. They start with flows changing. When money stops moving freely through a system, stress forms. Lending slows. Counterparties hesitate. Risk spreads quietly. And because nothing dramatic happens at first, people assume everything is fine. Another reason crashes start in unexpected places is complexity. Modern financial systems are layered with derivatives, leverage, and interconnections that even professionals struggle to fully map. Risk doesn't sit neatly in one asset class. It hides inside balance sheets, contracts, and assumptions. This creates blind spots. Take banks as an example. When people worry about banks, they usually focus on deposits. But banks rarely fail simply because people withdraw cash. They fail because assets lose value. Liquidity disappears and confidence between institutions collapses. One bank doesn't trust another. Lending freezes. The system stalls. By the time depositors panic, the core problem has already happened behind the scenes. The same is true for stock markets. Major crashes are often blamed on a single event: a war, a policy decision, a company failure. But these events are usually triggers, not causes. The real cause is fragility that built up long before the headline appeared. Fragility forms when systems become dependent on perfect conditions: low interest rates for too long, continuous liquidity support, ever-rising debt. These conditions feel stable on the surface, but they reduce margin for error. When something finally goes wrong, the system has no buffer. This is why periods of calm are so dangerous. Stability encourages leverage. Leverage increases exposure. Exposure reduces resilience. And resilience determines whether a shock can be absorbed or amplified. Crashes also tend to begin in places people consider safe: government bonds, major currencies, large financial institutions. These are assumed to be stable, so risk piles into them quietly. When confidence breaks in a safe asset, the shock is far greater than when it breaks in a speculative one. This is why currency crises are so destructive. People don't expect money itself to fail. When it does, every price in the economy is affected simultaneously. Another reason people miss the start of crashes is narrative comfort. Markets love simple stories. The economy is strong. Inflation is under control. This time is different. These stories reduce anxiety and make complexity feel manageable. But reality doesn't move in straight lines. Cracks often appear as inconsistencies, small anomalies, things that don't quite make sense but are easy to ignore. A market that rises despite worsening fundamentals. A sector that quietly underperforms. A sudden spike in volatility that disappears as quickly as it arrives. These are signals, not noise. Institutional investors pay close attention to these details. They don't need certainty. They need asymmetry, situations where potential downside outweighs upside. When they sense it, they adjust gradually. They hedge. They reduce exposure. They wait. Retail investors, on the other hand, are trained to watch price charts and headlines. By the time prices move decisively, it's often too late to react calmly. This brings us to precious metals, not as investments, but as indicators. Historically, unusual behavior in gold and silver markets has often preceded broader financial stress, not because metals cause crises, but because they reflect shifts in confidence. When trust in paper assets weakens, demand for tangible value increases, sometimes quietly, long before markets react. In today's financial system, this signal can be distorted. Paper markets, leverage, and derivatives can suppress or delay price movement. Physical demand and availability don't always align with futures prices. This disconnect is subtle, technical, and easy to ignore, which makes it a perfect early warning area. These are exactly the kinds of places crashes like to begin, out of sight, off radar, boring to most people. Geopolitics works the same way. Wars don't usually crash markets immediately. Instead, they strain supply chains, currencies, and confidence over time. The financial impact builds gradually, then suddenly becomes unavoidable. The key insight is this: if everyone agrees on where the risk is, it's probably already priced in. The danger lies where consensus confidence still exists. This doesn't mean panic is inevitable tomorrow. It means awareness needs to shift. Watching only what's loud makes you late. Watching what's quiet gives you time. At the Silver Collapse Report, that's the philosophy. We don't chase breaking news. We track pressure points, liquidity, confidence, leverage, and systemic stress. Because once a crisis becomes obvious, choices become limited. The most important decisions in financial history are usually made before the crash, not during it. During the crash, emotion takes over. Options shrink. Reactions replace strategies. If you've watched this far, you already understand something most people don't. Markets don't warn you clearly. They whisper first. In the coming videos, we'll dive deeper into where those whispers are getting louder. In currencies, central bank policy, precious metals, and market structure itself. Stay observant. Stay patient. And remember, crashes never start where everyone is looking. They start where no one thinks to pay attention.